Good morning. It's Thursday, the 4th of July, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. The take for today. Now, as the stock markets reach and cross new highs, the exuberance or excess, depending on which way you want to look at it, is slowly getting revealed and in different ways. Now, none of this is to say that the markets will crash tomorrow or in the near future, but it does demonstrate the relative weakness of the foundation it sits on. Translated, small and trigger-happy investors punting away on stocks and also, in a way, thankfully investing in mutual funds via systematic investment plans and the like. Now, the reason for all this, as I've shared before, is the sheer desperation to find ways of growing savings which are being devoured by inflation. That is, if those savings are growing at all. As I think of this, I wonder if an entire generation has only spent the last few years deriving satisfaction from the appreciation in their investments rather than any growth in real incomes and wages, and thus maybe caring less for the latter. And remember, this is not just stock markets. It's also about investments like crypto, where several people have lost more than their proverbial shirts, as I can say for sure. Though I do hope that this is not the case, as in that people are not punting away and are being more careful, but I'm not sure. There are several symptoms, and I'm sure we'll find more of them in coming days, which point to some of these excesses. Several friends, for example, are struggling with precise information on stocks they own or mutual funds they've bought. The reason they do not know or they are unclear about the information is because they buy through fintech intermediaries who in turn don't seem to be able to or are not updating their data properly and not in real time for sure, which is what people want. So I don't use any of these fintech apps for very good reason. So I can't claim first-hand knowledge. One friend told me that the value of her holdings as seen on one such broking app varies between rupees 2 and rupees 2 lakh and more. And despite much calling and chasing, the answers seem vague and not satisfactory, at least to her. Shyam Shekhar, the founder of iThought PMS, a SEBI-registered portfolio management services firm managing investor funds, had this interesting point on social media. According to him, zero broking fees, which now the SEBI is stopping because it was cross-subsidizing, has done more harm than good to our society. He argues that it has taken the culture of speculation into the lives of people who should never be speculating and normalized gambling in a class of people who can only be destroyed by it. The stock exchanges, mainly NSE, he says, use the zero brokerages to perpetuate a rampant speculative culture in the Indian middle class, he says. Now, the cross-subsidy argument is quite fair because the funds earned from speculators and derivatives was subsidizing the zero broking model where you don't pay brokerage when you buy or sell stocks. He also says that almost 95% of active users in zero brokerages lose money. Now, if you look at SEBI studies which talk about how investors invest in derivatives, for example, the numbers are quite similar, which is that most people actually lose money, particularly those who day trade. Now, this is not to say the reverse, which is that if you had brokerage or if brokerage was being charged, then there would have not been such high levels of retail interest. But the fact is that it contributes. And I'm sure you can see the combined impact of this. Think about it. Slick and smooth apps run by smart fintech companies where a few clicks can get you going, zero brokerage, and of course, powered by the sheer desperation that only high inflation can lead you to. And add another layer. Finfluencers and others on social media who keep telling you what to buy. And of course, anything that you threw the dart at in the last few years would have surely got you returns and perhaps much more. And finally, once you see others doing it, then you want to join the party. Now, this is a movie I've seen several times, and so have others, and are advising caution repeatedly, and I'll come to that in a moment. The Securities and Exchange Board of India itself is grappling on how to address an overheated market, though there are no obvious and imminent signs of structural weakness, except, of course, the inflated values of stocks themselves. Now, the solution, whether for SEBI or the Reserve Bank of India, which regulates the banking sector, will lie outside of the stock exchanges. For example, in the way personal loans are growing or savings are coming down. The regulators, to their credit, are alert to this or seem to be alert to this and also seem to be or having been racking their brains and scratching their heads for some time. But let's come back to fintech apps for a moment. If you had a bank account, I'm sure you would not depend on a third-party slick app to tell you what your bank balance is. Similarly, with stocks and mutual funds, do make the effort to go one layer deeper and beyond and start looking at the source, including with the depositories. Look at your statements, see what you own, what price, and maybe use a pure data aggregation website like Value Research Online or Money Control or Economic Times, and there are others, to write down your portfolio, the number of shares or units, acquisition cost, and so on. The fact that you write it down, the fact you take the trouble is going to help you understand how your investments are moving or will move much better. Believe me, you need to start treating your stock investments with the same care as you do your bank accounts. and the top stories for the day. The Sensex goes through another rapid rise. Speed thrills, but it's scary. The monsoons are late, but reservoir levels are a greater concern. Goods and services tax are lower last month, and how do they look 7 years on? How much screen time do Valley Tech CEO kids get?
This is a core report with Govindraj Ethiraj.
It's 80,000 time again, but the speed is concerning. The benchmark indices were on record highs on Wednesday, led once again by the financial biggies like the HDFC Bank, State Bank of India, Kotak Bank and Axis Bank. The BSE Sensex crossed the 80,000 mark for the first time today, hitting an all-time high of 80,074 and ended at 79,987, up 545 points or almost 0.7%. So it's kissing distance of 80,000 as close. On the NSE, the Nifty 50 touched a new record high of 24,307 and then closed at 24,287. That's up 163 points. In the broader markets, which we talk about nowadays, the BSE MidCap and SmallCap indices also rose about 0.9%. Now, while the market scaling new highs is always good news for investors, the speed at which they're doing so should cause some pause. Remember, there is nothing intrinsically that has changed in the fundamentals of this economy or, for that matter, most companies in the last many months, except perhaps you could say steady growth and, on the sentimental side, a return to political continuity, but it's a return for those who are betting on it. And then you can see capital flows coming back, given how languishing stocks like HDFC Bank are rising again, in this case about 4% to about 1,794. Now, this is the third fastest 5,000-point intraday rise for the Sensex in history, being from April 9th through July 3rd, according to Business Standard, which also says the index took just 57 days to gain the last 5,000 points from 75,000 to about 80,000. The fastest 5,000-point rally for the Sensex was about 3 years ago, that's September 2021, when the index hit an intraday high of 60,333 in just 28 days. Mahindra & Mahindra is one of the top gainers in this period and has gone up about 37%, data from Business Standard says. Fund manager and founder of Abakkus, that's spelled Abakkus, asset management Sunil Singhania told Money Control that investors should be cautious of this meteoric rise in the small cap and mid caps, though he felt overall market valuations appeared reasonable. According to him, public sector defense companies trading at 17 to 18 times sales are displaying excessive valuations. Similarly, he says companies associated with railways and those announcing ventures into electric vehicles have seen stock prices surge without corresponding profit increases, leading to a potential bubble. Singhania told Money Control that the Nifty, for example, on a fiscal year 25-26 basis is at about 17.3 times price to earnings ratio, which is only 5 to 6% higher than the 10-year average. And this, he says, is far from a euphoric 25 to 30 times price to earnings. And on a trailing basis, that's looking back, Nifty is at about 20 times and current valuations are similar to 2020, which means that the gains in Nifty have mirrored profit increases. As other investors have also told us, usually valuations are a slave to earnings. That's the term they use, which means the valuations follow earnings. So companies are doing well, they're reporting good profits, and therefore the valuations reflect that. How much rainfall is important? Monsoons were projected to be better than last year and quite likely will be, but the month of June, which sees the onset of monsoons on the southern coast of India and Kerala, has not gone well. There is a 11% deficiency so far, as we mentioned yesterday, quoting figures released by the Indian Meteorological Department. Now, there is no doubt that the delayed rains and heat waves, which we also saw, are affecting food prices, particularly vegetables. Former Agriculture Secretary Siraj Hossain points out in an article in Money Control that this is the third year of deficient rainfall in June. According to him, if the IMD's forecast for subsequent months turns out to be correct and the distribution of rains is not skewed, overall production of kharif crops or monsoon-planted crops like rice and pulses, which include dals, should turn out to be good. IMD data interestingly says that India's southern peninsula has received 14% excess rainfall. But the concern, says Hussain, is water level in reservoirs in southern states, which continues to be below average. The total live storage in these reservoirs as of June last week was about 16% of live storage capacity as compared to 20% last year and the 10-year average of 22%. Low rainfall in Karnataka and Maharashtra affected production of several crops, including sugarcane last year, says Hussain. On to vegetables. If monsoon rains in July turn out to be normal and well distributed, prices of vegetables could cool down by the end of September. Remember, September is still 2 months away, according to him. Interestingly, last year, despite a deficient monsoon, rice production was about 137 million tons and thus not hit much. We will, of course, continue to track the progress of the monsoon and keep looking at its impact on inflation, including food inflation, and the overall economic sentiment, which is important. GST collections are down, and the broader 7-year picture. GST collection for June 2024 stood at about 1,74,000 crores or 1.74 trillion rupees, roughly 7.7 or 8% year-on-year growth, according to sources that spoke to Business Standard, which obviously means the figures have not been put out in the same way they've been put out in earlier months. The year-on-year growth is notably less than the 12% and 10% increases recorded in April and May. Month-on-month, which is sequentially, figures were also flat, says the Business Standard. The source told Business Standard that the June revenue brought the financial year to date to about 5.5 trillion rupees. That's financial year to date, which started on 1st of April and ended on June 30th. The official told Business Standard that growth was not as robust as in past months, with various underlying factors contributing to this. However, he was confident the upward trend would continue. I reached out to Pratik Jain, partner indirect tax at PwC, to get a sense on how he was viewing tax collection numbers, but also to ask about how, 7 years on, where GST collection stood, and more importantly, what his clients were telling him in terms of the challenges they faced.
While we look at the month and 1.74 and say, okay, it's only increased 8%, you have to look at last year corresponding number as well. I mean, if you look at the overall FY24 GST collection on a monthly basis, it was around 1.65 or so. This year, based on the trend that we see now, in the initial 3 months, we are set to perhaps reach around 1.8, 1.85 lakh crore per month at the end of the year, which is FY25, which is quite decent if you compare where we started in the first year, which is July 17, was around 85, 90,000 crores. So the tax to GDP ratio, of course, has not arguably increased a lot. But tax buoyancy for FY24 been around 1.4. And this year, we are saying around 1.1, but I think the way collections are going, it should be more. So overall, I think we are in a happy situation with the GST collection numbers. Also, you have to bear in mind the tax base has significantly expanded. So, before GST came in, around 60 lakh registered taxpayers were there. Now it is around 1.4 or around 1.4 to 1.5. So therefore, tax base has significantly increased. And if you see that increase in the overall collection, you have to bear in mind that is not because of increase in tax rate. The effective tax rate has come down, and around 15% was the revenue neutral rate that we wanted to achieve, and we are at around 11.6%. So overall, again, if you look at holistically, I think that GST collections have been good. Of course, the government would want it to be better. I think FY26, average collection to my mind, the way we are seeing the government going, should touch 2 lakh crore per month.
That sounds obviously quite optimistic. But within this current GST collections, what are you seeing in terms of trends within? I mean, between, let's say, import duties and domestic taxes and so on.
So see, for this month, I think the press release hasn't come. But if you look at the last month and the month before that, you saw the domestic consumption as a percentage was higher, or the increase due to domestic consumption was higher than imports. That means that GST collection increase is largely led by domestic consumption and not necessarily by imports. So I think the consumption remains, I think, overall strong. One is the consumption part, and second is quantum of amount of data the government has. The tax avoidance or evasion is becoming more and more difficult because everything is available, from a technology standpoint. And that they've just started, frankly, leveraging that data, integrating between GST and income tax and so on. So therefore, as we go progress further, it can only improve from here.
So, when you talked about 2 lakh crore, which of course is not too far from, let's say, an average of 1.8 lakh crore, but you're still looking ahead and projecting in some ways growth in the economy as well 6 months from now.
So if you look at this year, FY25, we're talking about a nominal GDP growth of around 10.5%. And these numbers sometimes change, but that's the estimate. And we're talking about a tax collection increase around 11.5, 11.6%. I'm talking about GST. Therefore, to be talking about 1 point around 1 or 1.1 of tax buoyancy. So, of course, GDP is expected to rise, but the question is whether the GST collection would be more than the nominal GDP growth. And I think if you're able to maintain anywhere between 1.1 to 1.5, 1.6, I think you will see a basis there now.
Right. So, can you explain to our listeners what you mean when you say tax buoyancy as well? When you say tax buoyancy is 1.6, what does that mean?
What it means is that you have a normal, let's say GDP, a nominal GDP growth, which is your GDP growth plus inflation in that year. So that is around 10.5%, let's say, projected for FY25. And we are projecting a GST collection of 11.5. Then the difference between these two numbers, which is 11.5 minus 10.5, becomes the tax buoyancy. So more your tax buoyancy, it would basically mean that your tax collections are growing faster than your GDP growth. And that is what one would want to achieve, right? Because you still believe that there are pockets where there is still tax evasion and so on. So as you start plugging it more and more, you would expect the tax buoyancy number to go up as we go along.
Right. So we've completed 7 years of GST. As you look back and look ahead, so one of obviously the common refrains and demands is for greater rationalization of taxes. That means we have lesser slabs. And secondly, of course, is ideally to maybe bring down some rates. For example, I can think of air conditioners. A lot of people would say, why is it being taxed at 28%? And of course, there could be many other examples as well. So, what in your mind, as you look back and forward again, is the trigger for greater GST collection apart from the economic growth itself?
I think the biggest reason for increase in GST collection is the structure of GST because it's at each stage of value addition. And the data is available with the government, and also the structure is such that I, as a business, when I purchase something, I don't get input credit unless the vendor has paid tax and that evidence is available with me. So therefore, if I'm a large business today, I will want to deal with more compliant vendor ecosystem. So it's a self-policing kind of a mechanism. And because you have things like e-invoicing and e-way bill on transport of goods, etc., and everything is recorded, obviously the tax evasion becomes more and more difficult. So I think the biggest reason is the structure per se of GST, which forces you to do a self-policing, and the data that the government has makes it difficult for businesses to avoid tax. I think these two are the two reasons which comes to my mind. Of course, as I said, the effective rate of tax has not necessarily gone up when you compare GST rates compared to the previous regime. Now, you did talk about rate rationalization, and in the last GST Council meeting, there was a discussion on that. And now Bihar Deputy CM has become the convener of that GOM, and he's going to chair that. And hopefully, things will move faster. The idea is that the four slabs that we have, 5, 12, 18, and 28, you collapse those four into let's say, three slabs. So either you say 5 and 12 merged into a single rate, or 12 and 18, or so on. So there are multiple options. Of course, government will look at when GST Council will examine once the GOM report comes in. But yes, simplification is required, and I think there is larger consensus on that.
As you look ahead and when you talk to your clients, what are their top two or three concerns in terms of, let's say, the entire GST regime and the administration of it?
See, there are two, three things. One is the concern is more about, not too much about the tax rates. I think the concern is more about the tax administration part of it. I think disputes have seen an increase, significant increase. The mechanism that the government had of advanced ruling and things like that has not worked really well. So, and then different states, because I have multiple registrations and so on. Once I start getting notices from one state, quickly other states follow. So therefore, the quantum of disputes have increased significantly, and that remains one concern. The law itself is a bit complex, I would say. It needs to be simplified more. Cost of doing business is an area where There has to be more focus. For example, still there are a lot of expenses which I pay and I incur GST, but I don't get any input credit on that. There are sectors like real estate and so on where input credit is not allowed and the rate has been reduced. And then, of course, electricity is out, petroleum products are out. So all of those things have to happen. But the number one thing, if I have to say what people are concerned about, is more about the number of notices, aggressive audits, and so on. And therefore, I think the next wave of reform, not only the structural rate rationalization part of it, should also include administrative reforms.
Pratik, thank you so much for joining me.
Thank you. Pleasure.
Data centers are going nuclear. So you probably know that data centers are turning out to be the next big energy-guzzling monsters on planet Earth right now. Data center power consumption is shooting up in turn because of, among other things, high-intensity artificial intelligence chips and their applications, which makes me wonder for a moment, is it really worth it? I'm going to be back with more on this, as I did ask around a little to understand how much energy are data centers really consuming, in India at least, and waiting for some figures as of now. But I think the larger question which we need to keep posing is, how many do we really need and how much do we really need? And should we calibrate? Because we can't be cutting down energy consumption on one end and going ballistic on another end because of the need for speed. And you can't trust tech companies to give you a very clear view because it is in their interest to sell faster chips and faster computing, whether or not it actually makes a difference to your life, whether as an individual or as an enterprise. The Wall Street Journal is now reporting that tech companies are scouring America for electricity supplies, and they've now zeroed in on a key target, America's nuclear power plants. Apparently, the owners of almost 30% of US nuclear power plants, or one-third, are in talks with tech companies to provide electricity to new data centers needed to meet the demands of an artificial intelligence boom. Amazon Web Services is apparently nearing a deal for electricity supplied directly from a nuclear plant on the East Coast, with Constellation Energy the largest owner of US nuclear power plants, according to people familiar with the matter speaking to Wall Street Journal. In a separate deal in March, the Amazon.com subsidiary purchased a nuclear-powered data center in Pennsylvania for $650 million. Now, these plants sit or will sit next to data centers, so no real or limited transmission and distribution losses or such challenges. Actually, this is quite crazy and almost science fiction-ish if you think of it. Imagine, let's say, a group like Adani who's getting into this business in India, buying a nuclear power plant in the country to power its data center. In India, by the way, by law, for good or bad, private sector is not allowed into nuclear power. Of course, the lobbying to change this has been going on, I guess, for about 2 decades now. Anyway, the Wall Street Journal says nuclear-powered data centers would match the grid's highest reliability workhorse with a wealthy customer that wants 24/7 carbon-free power, likely speeding the addition of data centers needed in the global AI race. But of course, as the Wall Street Journal rightly points out, that instead of adding new green energy to meet their soaring power needs, tech companies would be effectively diverting existing electricity resources. This in turn could raise prices for other customers and hold back emission-cutting goals. Now, the same could and will happen in India, though a little differently. Apparently, the data center that Amazon purchased in Pennsylvania can receive up to 960 megawatts of electricity, obviously enough to power hundreds of thousands of homes. The relatively new arrangements will mean data centers can be built years faster because little to no new grid infrastructure is needed. Data centers could also avoid transmission and distribution charges that make up a large share of utility bills, says the Wall Street Journal. If you like what you are listening to and would like to collaborate with us at The Core Report, here's some good news. We are happy to announce the launch of the Core Brand Studio. Write into my colleague Shiva Chaudhary at shiva@thecore.in. I repeat, Shiva, that's SHIVA, at thecore, THECORE.in for more information. How much screen time is good? Ever since I read about Bill Gates and other tech CEOs and how they were moderating exposure to social media for their children, I followed this theme or space somewhat closely. Basis the assumption or presumption that tech CEOs have a pretty good idea of the harm that excessive social media can do and thus are careful with it in their own family environments. Peter Thiel, well-known investor in Facebook earlier on and co-founder of PayPal and Palantir Technologies, among others, says he does not like his kids spending too much time in front of screens during the week. He was speaking to Andrew Ross Sorkin of the New York Times at the Aspen Ideas Festival last week. In that conversation, Sorkin asked Thiel about the recent announcement of US Surgeon General Vivek Murthy that his office would push for labels on social media platforms warning about the dangers they pose to children's health. That article in its original form could be or can be seen on the New York Times too in the form of a column by Vivek Murthy. Now, Thiel says he allows his children just an hour and a half of screen time a week. His children are 3 and 5 years old, apparently. Business Insider says Thiel isn't the first tech leader to admit that they strictly limit their children's screen time. Snapchat CEO Ivan Spiegel apparently said he limits his 8-year-old screen time to 1.5 hours a week. Business Insider also quotes Google CEO Sundar Pichai saying earlier he didn't give his middle school-aged son a cell phone and that all televisions in his home are locked with an activation energy that makes watching TV not easily accessible. Anyway, here is the clip of Thiel speaking with New York Times' Andrew Roskin at the Aspen Ideas Festival in the United States last week.
There is some kind of a interesting critique one can make of the tech companies. And if you ask how many of the executives in those companies, how much screen time do they let their kids use? And there's probably sort of an interesting critique one could make.
What do you do?
Not very much. And I think that's very...
What's not very much?
An hour and a half a week.
Hour and a half a week.
Something like that.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.